ladies and gentlemen, members of the Venture Capital Roundtable, welcome to the World Innovation Summit. Welcome to the city of Barcelona. My name is María Ortiz. I am a representative of the Universitat Politècnica de Catalunya. I am a member of the Science Park of this university. The Universitat Politècnica de Catalunya is a public higher education institution specialized in 3 fields: engineering, science, and architects. The UPC activities are related to academics, research, and transfer activities. The UPC and myself, today we have the honor to be here to introduce you the members of the Venture Capital Roundtable. The 6 members of this table are representative of very important companies with international prestige related to venture capital and entrepreneurship. The 6 members of the roundtable has very interesting experiences, professional experiences in his curriculums, in their curriculums. All these people will speak in this roundtable about the topic. They will explain us what is needed, qualities needed to companies that aim or that want to be or attract funds and become international. Let me now introduce you one by one, all the members of the round table. Randy Komisar. Welcome. Randy Komisar is a partner of KLEINER Partners, CAUFIELD and BYERS. He is author of some books and articles related to leadership and entrepreneurship and managing innovation. Mr. Graham O'Keefe, he is a venture partner of Atlas Venture. His interests focus on investments in communications technology companies, particularly in the wireless and semiconductor sector. Mr. David Ladd, he is a venture partner of MAYFIELD. He is expert in communications and VoIP. He was co-founded a company, a voice messaging company, before joining MAYFIELD. Mr. Garrett Gruener, he is co-founder and director of ALTA Partners Bay Area. He has an important experience in the fields of software development, systems engineering, and corporate development. He also founded a company, a communication software company. Mr. Fergal Mullen, he is a general partner in HIGHLAND Capital Partner. His primary areas of interest are e-commerce, software, and business services companies, with a particular emphasis on emerging growth opportunities in Europe. And the last member of the roundtable is Ms. Diana Frazier. He is a co-founder and managing partner of FLAG Capital Management. This company managed £4.4 billion in client commitment. Dollars. She has a lot of experience, a very important experience in the venture capital and private equity sector. She has also an important experience in international in economic consultancy and systems analysis. He is a member of the National Venture Capital Association and member of the MIT Sloan School of Management Dean's Advisory Council, among others. So she's going to be responsible to moderate the roundtable. Thank you very much, Ms. Diana. Thank you very much to everybody in the roundtable. It's a pleasure for us to have you here and to know and learn from your experience, professional experience and company's experience related to entrepreneurship and venture capital. Thank you.
Okay, guys, we have around this table 90 years of venture capital experience and another 90 of operating experience. So I hope we're going to be able to get out some of the incredible things that are in these men's brains that are going to be able to help you, because there's an incredible amount of talent sitting right here. We're going to talk a little bit about how to get your company funded, what kinds of dollars or pounds you need, how to get to a VC, what a VC is looking for if that's the route you take, or what any kind of funder is looking for. And then we're going to throw in a few other fun things at the end if we have time. So let's get started. We're going to have this try and be very free form and just get everybody to chat. How do you get your company funded? What are the various ways you can get them funded? These are all VCs, but they've also have very strong biases, so I learned in the pre-meeting about what to do and what not to do. Looks like Graham's sticking his head up. Is that right? You lean forward. Don't lean forward.
So I think the thing to remember about venture capital funding is it is primarily for very, very risky propositions. And the returns for venture funds are very much biased by the outliers. So if you look at the number of dollars that get invested by VCs, about half of them get lost in some form or another. And about 50% of the dollars make some money, of which 10% are the outliers. And it's the outliers that make the outrageous returns from the funds. You know, I mean, Facebook hasn't exited yet, but you know, the Googles and Amazons and eBays and those kind of ones. And that's really what VCs are after. They're after very, very high upside kind of businesses. So for a lot of new ventures, venture capital is not appropriate. You know, it might be more appropriate to put together a small angel round if you have a very capital efficient business. You know, some people will mortgage their house to start a business so that they can maintain their independence. So venture capital isn't isn't for everybody. It is very useful if you're trying to scale your business very quickly, if you want to compete internationally, if you want access to very, very rare skill sets which might not be available through your own resources. So anybody approaching a VC should be very inquisitive of them as to what can they deliver in return for the share of the company that they're naturally going to take.
Yeah, because you do have to take dilution. Is it worth it? Are there other ways to get funded?
First of all, take dilution. If you get smart money, take dilution. I see so many entrepreneurs that worry about dilution. You know, 100% ownership of a company worth zero is zero. You know, 5% of a company worth $100 million is $5 million. So I really encourage any of you entrepreneurs, don't worry about dilution. If you can get smart money, that means money that helps you succeed, and that's what venture capitalists are trying to do. I think you heard about corporate investors. That's possible. Some of them are doing seed stage. Bootstrap it yourself. There's a very active angel community, means mostly wealthy individuals that have made money, that are investing $50, $100, $200,000 in early stage deals. The most important point is you have to get to a point with that money where you've reduced risks. The VCs right now are a bit risk averse. So if you can take other money and get to a point with that money by bootstrapping, careful how you're spending, take smaller salaries, you know, a garage operation literally, but get to a meaningful milestone that reduces risk, customer traction, technology risk, whatever the risk of the next round is, that's what your first funding needs to do.
Are there other ways? Corporations? We had a corporate panel an hour ago. Okay, Garrett?
So, you know, the first job of entrepreneurship is to raise money. It's what you're always thinking about. It's what you begin with. It's what you go to sleep with. And I completely concur. You know, the issue is not avoiding dilution per se. The issue is how do you raise the money when you need it to be able to keep the enterprise going forward. One thing that I liked from the previous panel, and which I've used personally and to good effect, is that you can, I'm a little leery about corporate venture capital per se, but I really love corporate contracts. They do a lot of good things for you, including keeping you focused on actual projects as opposed to the current fantasies of the venture community. So if you can get a company rolling based upon corporate contracts and so on, that's a great way to get started.
How do you know the difference between a corporate venture capital firm and a corporate contract? I mean, a lot of people don't understand there's a difference.
Not only, well, there's a very clear difference. Corporate venture capital is typically coming from the corporate venture capitalist, whereas contracts are coming from the line guys. So line people within large corporations have responsibilities for products and services, and they have real problems they need to solve. And if you can help them solve them, not only will you provide finance for your company, but you may also be working with your eventual acquirer, which is in the end what it's all about.
Are they good to have in at Round A? Say you did decide to have a corporate venture firm. Is that a good thing to have in Round A? They're very smart people. Are they smart investors? Are they smart value add, to David's point?
I don't think you can generalize. They all have different models. Some are good at seed. They bring help from the VC community. Intel Capital, for example, used to have a model, they've changed it a bit, where they would only co-invest with good VCs. I like the IBM model a lot. The goal of most of our companies is to get access to these big partners. We don't really need their money to invest. We need their access. And the IBM model is strictly around finding out quickly whether I'm going to get anywhere with IBM. And that's what most of our companies are trying to do. Or, to your point, find out if there's an IBM division that would like to contract with this company to develop something unique or take this product to market. Figuring that out quickly is what I want from a corporate partner for my companies. I'm not big on having them do early stage investing.
Okay,
my general rule of thumb on this is trying to have a commercial engagement with them before the investment. You know, it's this kind of trial run to see whether there is value out there. Mm-hmm. The last thing you want is a corporate investor with what is often termed an eyes and ears view into your company, maybe board observer rights, information rights, special IP rights or whatever, and then you find that's not what you want because there is no commercial engagement afterwards.
Okay, use the word value add. Let's talk a little bit about what you as VCs are looking for, or let's generalize what corporations are looking for. What are you looking for? What can you help these people understand what they need to bring to you to get your attention? Let's hear from Randy. He's sitting there looking very contemplative.
Well, you'll hear a lot of cliches about what venture capitalists look for. They always say look for talent and they look for big markets. I find that since most ventures that I look at are very early stage, usually with an idea that's untested to market, maybe with a technology that hasn't even been created, the real issue is who are the people that are going to be able to solve the problems that are yet unknown. We're going to get involved in an investment with somebody who's going to have to answer questions that are still unanswerable because we don't have a product and we don't have a customer. And so finding people who can create the business on the fly as they get good empirical information about the real market and the real technology that they're working at is probably the number one thing that I look for. The second thing that I look for is a big problem to solve. Doing a venture is very, very hard. And I have found that it's just about as hard to do a small venture as a big venture. The problems may differ in scale, but the problems are all the same variety. And so I look for big problems to solve because it gives you a better chance for a big success and large impact. And thirdly, I look for a fundamental business proposition, a value to be gotten from a buyer and a seller in the transaction. That, of course, is sometimes hard to find in the consumer web, where the buyer is, in fact, also the asset who's being sold to an advertiser. But I like to find those businesses where there's a very clear proposition between a buyer and a seller.
So he works for KP, and KP is known for big ideas and swinging for the fences. But there's thousands and thousands of smaller ideas that make money. Can we talk about some of that?
One quick thing, comment on the people thing. What I look for is amazing domain expertise. If your risk is technical, you better have amazing technical expertise. If your risk is market, like an internet deal or a media deal, you better have somebody in that team that really understands how to go to market, how to reduce that risk. So when we talk about people, what we're talking about is those, you got to know more about it than I do, or my partners do, or we're going to catch you up. You have to have somebody on the team. So as you start a company, looking for who you add in the domain you're in is really, really critical.
So you come in and you come in prepared. Is that the only way you come in prepared with domain expertise? What else do you need to get their attention?
Dana, we tend to try to tick 4 boxes. Not that we're in the business of ticking boxes, but if you want a little formula or some sort of a quick cheat sheet on what we look for, number one, we're looking for a great team. The founders, they don't have to be rock stars, but they better be great people with passion and knowledge and better know what they're talking about. So team is number one for us. Market is number 2. And that brings me to the point of you have to understand who it is you're talking to. Some VCs are more early stage focused than others. I happen to be, in my strategy, a bit more venture growth focused. So if you come to me with a seed stage financing, chances are it's going to be hard to get my attention and I will divert you somewhere else. But on market, we're looking for big market opportunities that are close at hand. We're not looking for market opportunities that are 5 to 10 years out. Next, we're looking for a product, and the product has to have real differentiation, real defensibility, and a value proposition around it that makes sense from a consumer, customer, or enterprise standpoint. And finally, we're looking for a plan that makes sense. And that's not to say that we're going to bank that plan and come back to it every year and review it with you. But you better give us some sense that you know what you're talking about through your plan. And the plan includes the financing plan. How much you're raising, what you're going to do with the money, how far it's going to get you, and what the next steps are if it doesn't get you all the way to profitability.
Well, what about the really early stage guys who haven't a clue what they're going to need?
Well, I think
You're talking about pretty mature-ish thinking
mature,
here.
but
does that mean that VCs don't do real early stage anymore?
No,
which
that's
is
not
what they
true.
keep being accused
Everybody's
of?
got different strategies, and I think we skipped off the first question very, very quickly around, you know, what are the sources of money and where do you get money? I happen to think Europe right now, and I'm based out of Geneva, working the European market on a pan-European basis for an American VC firm. I think there are lots of sources of money in Europe, and it's a little bit fallacious to say that the money's not out there. There's regional money, even in this region here. You've got regional development funds, you've got national development funds, you have university funds, and you've got a very, very active angel network in most countries that should be mined and mined aggressively. The question is, what do you do with the money when you get it? Because I don't think it's actually that hard to get money nowadays if you've got a half-decent plan and a half-decent team. The question
So you're saying it doesn't come with value add?
Not always.
Yeah.
But the value add could be an office space. The value add could be just the money itself. And not every company at that stage is ready for venture capital. They haven't figured out whether they want our money, because our money comes with some overhead, let's be honest.
Right.
The only caveat is I've looked at a lot of government-funded deals, and the money always seems to go to product only. And again, I'll emphasize, it's rare that the product is the risk of your success. It's the market and how you go to market and how profitable how much it costs you to go to market and how much money you can sell it for, all those things. So if you get money from other than, if I'll call VCs a professional source to beat this into your head when they're on your board, you really need to figure out a way to get help from some business entrepreneur that's lived through this. I strongly urge, if you take money from a government or an agency and here, go build a prototype. Yeah. It's the wrong thing to do most of the time. If there's technical risk and the money needs to be used to reduce that technical risk so that somebody's interested, okay. But most companies, it's not about technical risk. And most entrepreneurs are technical, and they think if they build, I did this, made my mistake when I started my own company. I thought if I build it, what the heck, the world would beat a path to my door. Built a prototype, used my own money, and it was a mistake. So I strongly urge you, take money from wherever you can get it, but use it to really understand what risk around the market you can reduce. If you can get a contract from a customer, it's great. Use that money to go work to get some customer to validate that what you're doing makes sense.
I have an opportunity on my desk at the moment, which is a seed investment in a semiconductor company. And I think semiconductor companies are probably the most unfashionable thing to invest in at the moment, given the capital intensity. And they're trying to raise $1 million. And I said, what are you going to use the money for? And they said, to hire 5 engineers. And I said, well, I don't think that's the right use of the money. You might be a chip company, but at this stage, you need to know what your customers really, really want, not now, but in 2 or 3 years' time. So my advice to them is to spend the money on a whole lot of cheap plane tickets to Taiwan and Japan, talking to mobile carriers, consumer electronics ODMs, so on and so forth, to figure out the trends in the industry, the price points, the feature set that they really need to be developing against before they hire the first engineer. Because my experience with chip companies is the chips usually work, but they often mismatch the market that's available at the time they eventually work.
Okay, so let's assume you have the money from someplace and you've gotten smart enough to have enough pulled together that a VC will listen to you. How do you make sure you're at the right VC As you said, a seed guy comes to you, that's a big mistake. How many times have you seen the wrong person come to you? How many times can we instill in their heads they have to know their customer? Can you talk a little bit about that?
First of all,
Randy's shaking his head down there.
Go ahead.
Well, I think you can hear just on this panel the various different interests that the venture capital field has. Also the very different skill sets that people have. And I think it is possible for you to do your research today, particularly online, talking to other entrepreneurs that have worked with the partner, not just the firm. Because if you think you're going to essentially partner with a venture capital firm, you're mistaking the process. Process is there'll be a partner, maybe two if you're lucky, who focus in on your business. They're going to be pivotal to the resources you get and to the way in which your investment is treated in the firm. And so picking the individual or individuals that are going to work with you are important. Picking the firm, the style of investing, and their history and experience is important to you. And all that can be researched ahead of time. It doesn't make a lot, it's not a vanilla industry. It's very different. It's a very, it's really dominated by individuals, personalities, and individual experience.
So sending a plan over the transom, as we say, just mailing it in, that doesn't work, right?
I find it, I've looked at a lot of them. I read every one that comes in and can't remember one we funded. Your best way is try to get an introduction through somebody that knows the firm. And you know, we're out there a lot. And conferences can help. You know, we can get a chance to see 22 deals here, and that can help. There's a lot of these conferences going on now. But the best way is an introduction from somebody we know, like a former entrepreneur or a professor at Stanford University, or the network, if you will.
We run a fund-to-fund, so we invest in funds, and I can't tell you how many deals I get, and they say, oh, just introduce me to Highland, or just introduce me to Atlas. Tell me what you do. Give me what's the favorite word we all like? The elevator pitch. How important is the elevator pitch to get the attention?
For me, it's crucial. I can remember to this day the pitch I got from Robert Keane, the founder and CEO of Vistaprint. I met him at a school auction. Our kids happened to go to the same French school in Boston, and in about 5 minutes, no more, he told me what his business was doing and why he was going to build the biggest online printing company in the world and why it was going to be extremely valuable, and how he had built a technology that nobody could replicate easily, and how he had patented that technology, so he had great defensibility. He talked about his customer acquisition model, and it was a jaw-dropping pitch that is yet to be beaten. So it's a high benchmark. But if you can't describe your business in a very crisp way, it could be 3 minutes, it could be 5. Hitting the key points: what you do, why it's important, why it's going to be a big business, why you can make money as a venture capitalist if that's who you're pitching. Then work on it, I would say. Work on it. It's very important.
I think Garrett's trying to say something.
So I think all of entrepreneurship is about sales. It's about first selling your company to whoever it is who's going to invest in it. It's about selling it to understanding and selling to your customers, and it's ultimately about selling the company. And whenever you're selling, you're trying to first understand the language and context of your customers. And I'm always struck by the fact that venture capitalists do a lot more work on their potential investments than the entrepreneurs do on the venture capitalists. And that's a mistake. You want to understand who it is you're selling to and understand what their proclivities are and what their biases are, and go after the ones that matter, because there are many, many, many more sources of capital than you could possibly talk to. You only want to be talking to the few that might actually be interested in your enterprise.
So what does that mean? If you have a consumer web company, you should be hanging out at Shake Shack in New York. But if you have a chip company, you'd better not bother wasting your time going there. I don't know what the comparable things are in Europe, but I'm sure they exist. Can some of the European investors share with us where are the places you should hang out if you want to get a certain kind of company funded?
It's really, I'll speak to internet, consumer, digital media type investments. It happens to be where I'm spending just about all of my time right now. And it's really not hard. Let's be honest, there's only a handful of pan-European VCs that have reasonably deep pockets. And there's 2 or 3, maybe 4, maximum 5 country or regional-based VCs in any country or region, and then there's some major angels in that country as well. They're the sources. Do your research, do your homework, and look at who's doing what their most recent investments have been. You know, I'm disappointed nowadays when I don't hear about new e-commerce ideas. It's kind of where I've set out my stall, and whether the idea is coming out of Berlin or Paris or London or Dublin or Barcelona, Madrid, I want to know about it. So I'm very actively searching, and if somebody doesn't know that I'm in the business of looking for deals in that space, then it's partly my problem, but I also look to the entrepreneurs to do a little bit of homework and figure out who's doing what. It's not difficult.
And where's the homework? The blogs?
It's the internet. I mean, everybody has a resource at hand nowadays that is something that just wasn't there 15, 20 years ago. Everybody's got websites. We've all got, we're all at forums like this. We're all visiting cities all the time. Just call us up. It's really not a problem.
It's worth emphasizing, other than just market focus, the things to pay attention to on our websites are geographic focus. Many of the firms like to stay in a certain area. You know, we talk about it, the bar is higher the further away you get from Silicon Valley. So we've done a deal in Europe, 1. You know, we've done a deal in Boston, 2. We've done deals in Silicon Valley, hundreds. So you got a later stage. We do early to mid, you're mid to late. Look hard at what stages, will they do early stage? Which partners focus on early stage? Do they do seed? Many firms don't, VC firms. Are they willing to take 2 guys with a bright idea and help build a team around you? Is that something they've done? And I also agree, talk to you're a buyer as well as a seller. You have a product, which is your company that you're trying to get funded. Act proud. Don't beg. Act proud. Go ask for diligence about the VC. If they start to be interested, can I talk to some of your CEOs? Can I find out about you? You want to find out what value add they're going to bring, how much they're going to help you. If you get that rare option to be selective about who you let invest, be selective and do your homework.
I think there's a very good point you made there about getting to know the CEOs of the portfolio companies. Venture is it's a kind of semi-social business, and this process of socialization before you engage on an investment level is an important one. I will, if it's relevant, people send me a lot of stuff, but if it's kind of interesting, 45 minutes of my time over a cup of coffee, just hearing something quickly, a sort of extended elevator pitch, throwing out a few ideas, seeing whether the entrepreneur can think on their feet. You know, who do they know in the industry? Who should they know? And help them out with a couple of leads, CEO introductions, CTO introductions, that kind of thing. It's a very useful filter for us, because then you can sort of follow up and you say, well, you know, what did you guys think of this? You're much more in tune with the sort of zeitgeist of this particular industry than I will be. And that is a very, very useful filter for us on these new ideas that come in. And often the idea is not a good one, but it might be that a refinement of it or the next stage is a good one. Or it might appeal to somebody else, and the entrepreneur will remember you for having helped them out a little bit next time round.
Mm-hmm. Mm-hmm. Randy, do you have something to add about this topic?
Well, I usually end up spending a great deal of time without any semblance of an investment in order to get to know the people better. It's never too early to meet the venture capitalists that you think you may want to work with, even if you're not looking for money. And again, that's a cliche. The entrepreneurs come in all the time saying, we just want to sort of show you what we're doing, we're not looking for money. But in reality, that actually is a good time to meet the potential investors that you're going to work with. Because we talk about value add, but to be frank, that value is very, very different depending upon the individual. And you've got to think about it in the context not just of your company, but of yourself. Is this person going to partner and mentor you in your position as a founder, CEO, to grow the business and grow yourself and your organization in the process? Will you learn in that process? And what can you learn in that process? It's not just about opening doors. And if you think it's just about money, I defy you to look at this group and think about us as bankers. That's not the way we think about our businesses. That's not the way we think about how we invest. It's clearly not the background and experience that we bring, I think, successfully to our businesses. We're not bankers. We partner in the building of businesses. And we bring money, but we bring a lot more to the table than money. If you're looking for money and if that's all you need, you probably don't need to be talking to a venture capitalist. You need to be trying to figure out how to get to a banker or to corporate development funds or whatever, wherever the cheapest source of capital is that's available to you.
Let's talk about some of I'm not going to say business plans, because today very seldom do you actually look at a business plan, but whatever the pitch is. Let's give some hints of some of the great pitches you heard. Fergal told us one, the elevator pitch, but tell us some things that really are going to get your attention, that are good, and maybe show us some things that you didn't like, that turned you off. Who wants to start?
It's funny, I think in business school they teach you, talk about how big the market is, and then talk about, or introduce the people, how big the market is, and then, what you're doing and competition. So you've all read this or been in situations where you can read about it. I would skip, I want to know what you're doing first. You tell me how big the market is, I don't have a context. So one tip is, give me, a couple of minutes on, we're going to go be the dominant company in this market. We've developed technology to do this. Introduce yourself, but don't tell me what you did from the time you were born. I've had companies that come in and they used up 20 minutes of the 1 hour they get talking about the people. I just need to know relevant experience. I can read the rest. You have 1 hour to impress us. And what we're mostly doing is judging you. The other thing you'll find is VCs are incredibly good at interrupting you and taking you off topic. I tell every one of my companies that I advise, when a VC says, well, what about this? I'm going to cover that later. Okay? I'm sure you guys, you're all smiling. We all do this. Our partners do this. They're thinking fast. They understand the market. They've seen other deals like this. They're trying to get to the nuggets. What's important? Why you? Why are you different? What's unique? And then, obviously, a competition and a financial plan that includes funding is critical. I tell people I want to see quarterly financials till profitable. And I don't care if it's two guys. Show me you understand what it takes to get to market, or you've talked to people that understand, and you can put together a 3-year financial plan.
So the growth of the mobile market chart, leave that out.
Leave how big the internet's growing. I give you that. Video's hot. Mobile phones are big. It's the next. I get it. Thank you. Don't have to tell me.
Which gets the point that you don't know your customer. If you show up with that kind of stuff, it's an insult. That's right. He better know that stuff, or she better know that stuff.
We spend a lot of time, all of us do, preparing for looking for the right deal. We literally go and study markets and talk to CIOs and talk to Nokia and talk to, Google and Apple and what are you guys seeing? What are you looking for? Where do you see the world going? And therefore, when you come in, we're usually prepared to think about the business you're proposing, because that's what we think the world's going.
But the corollary to David's point is you better know an awful lot about who else is in your business. When you present to me, I really want to hear why somebody cares about what you're doing, meaning who's the customer, and what are the other solutions that customer could be looking at. I am surprised how often an entrepreneur comes in unprepared to talk about the context in which they're going to have to operate. Who else is creating products out there? And when I start throwing names out, if they don't know who those people are, I already begin to feel like they're unlikely to be investable. Because if they haven't kept up with what's going on in their market, if they can't distinguish themselves from others who are currently in the market or are entering in the market, then they probably aren't backable.
Yeah. That's an excellent point.
There's a lot of, I have a video, there's others that have videos, mine's on the Stanford Business School website, of how to pitch a VC. I mean, there's no excuse with the internet, as you said, to not be able to learn how to do this. There are, I don't know how many sites or videos or those of us who have given talks that have been recorded showing you how to pitch a VC. There just isn't a good excuse for not doing it well anymore.
I've seen so many European pitches that are just so awful. I mean, I don't know what it is we have with our education system. We were talking about this earlier on. I went to school in the States until I was 8 years old. And the school I went to in America, I was known as the little English boy. And then I went back to school in England where I was known as the little American boy. And that took about a week. But we used to do this thing called show and tell, where you would turn up with your favorite toy, whatever it was, and you had to stand up in front of the class and explain in 30 seconds why this was the best you know, Buzz Lightyear or, you know, whatever it happened to be, iPad probably now, the 8-year-olds get. And maybe that's the reason, I don't know. But Americans are extremely good at pitching and very, very good at selling, at knowing the audience and being able to make a connection. And there's this expression about taking your audience from A to B. What is A? Where do they start? What do they know about you? You know, what are their preconceptions? And what is B? And A might be, you know nothing about my business, you know nothing about me. B is 30 minutes later, you want to write a check. And that's the journey you've got to take your audience through. And for some reason, I find it, you know, the correlation between kind of European origin and not being able to do that is quite extraordinary, despite all the fantastic videos that are on the internet. So, you know, learning how to pitch is extremely important, and it's not about watching, you know, Dragon's Den. It's not a sort of Hollywood thing. It is something that can be practiced. It can be learned through repetition. You need to try it out on your friends, in front of the mirror, videotape yourself, do whatever it takes. But find a way to make a short pitch, no more than 20 slides, which gets your VC from A to B. And B should be, you know, the next meeting or a full partnership presentation, or figure out what that is. But that is the thing which lets down European entrepreneurs. The biggest business that I have not invested in, and I should have done, was a company called TomTom. And I knew the guys who did it and had worked with them before. And you know, it's clearly been a spectacularly successful European investment. I didn't screen it beforehand, and I should have done, but I took it to two of my colleagues. And I have to say, if it's not the worst presentation I saw, it's certainly in the top 10. Just inability to sort of convey what it was they were trying to do. And you know, it was obviously desperately disappointing for me that it wasn't great. But, you know, and it should have been, and there's no reason why these things can't be good.
Anybody else have a plan that they missed because it was so badly presented?
A lot of times, I'm just going to generalize, the early stage plan and the entrepreneur who spends a lot of time with the early stage plan, sort of wedded to the plan. When I generally see that the plan has to change over time. It's a recent book that I put out called Getting to Plan B is about a different way about thinking of the innovation process as not executing against the plan, but instead finding the right plan and doing that in an incremental way with good empirical information, reducing risks along the way. And so when I look at a plan early on, I seldom even think about funding the plan. The plan to me is an interesting, sort of the lingua franca of the business proposition. It shows me that they have been thinking about the challenges they have to face, and they are thinking about the model in which they are going to have to build their business around those challenges. But by no means is it a blueprint for the business. I've not yet invested in a business plan that turned out to be the business for a successful venture. It's always changed along the way. And so understanding the usefulness of the plan, being able to raise assumptions, talk about challenges, talk about the models that you're considering for building the business, versus talking about executing against a 5-year plan where you currently don't have the technology built and haven't sold to a customer. Those are two very different ways to think about how you're going to present to the venture capitalist. And more often than not, I see entrepreneurs walk in with a beautiful spreadsheet that has 5 years of projections in it for a product that's never been built, and they begin to explain to me how every single line item falls together to build their business. I personally don't believe that that is the right way to build a successful venture.
I think the focus needs to be on release 1, and then I think to Randy's point, you'll morph from there. Get release 1 out and get customer feedback fast. That's my mantra. Get it out and then iterate. And then smart people in a big market will figure out how to wind their way through the difficult challenges of building a big business.
Yeah, I heard a gaming...
Release 1 is very critical in this plan. What are you going to do with the money I give you? What are you going to develop? And how are you going to get to market?
I heard a gaming fellow say the other day that every game they put out is 10% done. And only when they get the traction do they kill most of them. And the ones that get the traction, they then build the other 90%.
Bigger companies can afford that. Small company that's hard.
Yeah, that's a different model. Gaming is very different from building a chip. Garrett.
So, there's nothing new about any of this. I think that the canonical business pitch was, Columbus talking to Queen Isabella. And, it's all there. It's a quick, the prospect is simple. If the vision is enormous and he got it wrong by, 18,000 miles or something of that sort, and an entire continent. But it didn't matter. They figured it out as they went along, and he was, in fact, the right guy to get it done. Yeah. So, I don't think there's anything American about this. It's about distilling a big idea and, convincing the people you're talking to.
And passion, a word that Fergal used.
Yeah, we're judging the person. I mean, I think, again, well, that's an interesting idea, but I've seen this, and I like that, and let's change it here. So I'll adopt an entrepreneur I like because of his passion and his brains and his smart, and help him work through to a different plan if I'm impressed by the person. So even if I don't like what I see, hey, you ought to go out and do this homework and check about this and talk to this guy. And some have come back and we funded them. So we are judging the person as much as the business, as has been said multiple times.
That's an interesting point. I've heard at least 2 funds up here in other venues mention that most of their successes went through the valley of death before they were successes. So that means that you really have to believe in the passion that you can get through that valley of death.
It comes back to the people.
Fergal?
Yeah, it's all about the people. It's not to say that everybody makes it through the valley of death. It's tough out there sometimes. And our value is to be able to help find the right people to complement a team when they're at those tough periods. And sometimes we do have to change out management and our founders, but we try to do that in the most smooth way possible. It's probably the most difficult part of the job that we do, yeah. And it's down to a human dynamic and really treating people with great respect. But it's hard sometimes, very hard, and but it has to be done sometimes.
And is that why they don't go to VCs? They're afraid they're going to be kicked out?
It's interesting, Diana, because in preparation for coming here, I read through all the business plans for the finalists and was impressed. Last night, I got to meet a number of the entrepreneurs, and I was a lot more impressed. It was humbling, actually, to have read the plan, sort of think about it in a sterile, objective, almost academic way, try to find the strengths and weaknesses of the plan, and then meet the entrepreneur. And the entrepreneur adds so much wealth to that whole assessment of what that opportunity looks like. It just reminds me how important it is to back the right people.
Mm-hmm. And you can't just hire a marketing person who's flashy. It's got to be the person who has the passion who's going to actually be part of the team. Would you agree?
Yeah,
you can't just hire a spokesman.
Yeah, there's a lot of definitions of marketing. I mean, yeah. You can hire a marketing person to build a website or print a brochure. That's for me, that's not marketing. Marketing is about understanding your customers and being able to translate that into a language which can be executed inside the company. And understanding how to run that feedback loop as well.
The founders of Google were not marketing guys, and you can't argue that they didn't create a big company by what the VCs helped them bring to the table. So my saying is I want at least one passionate entrepreneur around which I can build a team. That's what I'm looking for. I want at least a technical market. I don't care what segment they come from, but I need at least one founder that's passionate about it and you can build it and can recruit.
Well, Google was one of our companies, and the thing that I think was most evident at Google, and it's something that we've carried forward ever since in the last decade, is we don't even use the term marketing without the term product attached to it. It's product marketing. Mm-hmm. Product marketing. And that, that might be different if you're in the fashion field. It might be different if you're in the consumer electronics field. But fundamentally, for the sort of ventures we invest in, high-tech, disruptive ventures, that turns out to be the case. And just one sort of anecdote, last night I was talking to one of the teams, and 2 of the scientists working on it had been working on it for quite a while, and they just recently brought in a marketing person, and I asked what the marketing person brought, and they said they brought charm to the and I talked to her, and she was very charming. So so marketing brings charm to a good idea.
But you can't just be the marketing, the person who tells the story pretty. That person has to own it too. That's what I worry about is sometimes when people think, oh, go get a marketing person who's just a face. Can't be a face. That person has to be passionate too. Fergal, you were nodding your head.
Yeah, I mean, I've invested in a company here in Barcelona called Privalia. Some of you may know the business. It's two co-founders actually, who've known each other for many years. They worked together at Bain and Company here in Spain and in Latin America, and they came with a great idea to build one of these private sales businesses for the Spanish market, the Italian market, now Brazil and Mexico. And I tell you, passion. When these guys sit in front of you and they pitch you on their business, they are passionate. You get it? Not only are they passionate, they know their business cold, they know their market. It's all of us. It's consumers who are looking for good deals and branded items. And metrics, talk about metrics driven. I mean, if you're in the e-commerce business or any web business in general, you need to be metrics driven. You need to be able to measure everything from visits to customer acquisition costs to conversion rates, etc. These guys had it, and they had it in spades, and they lived it. It was in their blood, and they had surrounded themselves with fantastic advisors and investors, like Luis Martin Cabieres, who's in the audience, I think. I mean, they did all the right things to get the company from A to B, and the most impressive thing I think they did was be capital efficient. So they got the money, and this might pull us in a slightly different direction, but they got money, not a wild amount of money, but when they got it, they used it extremely well, and they went from 0 to essentially a 50 million run rate with about 5 or 6 million of capital. Yeah. How often do you see that nowadays? Well, I can tell you when I see it, it gets my attention big time, because it tells me a lot about the entrepreneur and their tenaciousness and their ability to do a lot with very little. So that's just a little anecdotal story about coming back to what excites me about certain business plans.
Yeah, there's a lot of talk today about capital efficient business models, and it works for some things and it doesn't work for others. Do you have to have a capital efficient business model today?
Well, they should always be efficient.
Right.
The question is, what's efficient in different markets? It's very different if you're going to do a consumer web company where it's possible to actually get an entertaining product on the web for tens or hundreds of thousands of dollars versus building a new biofuel that's going to take hundreds of millions of dollars to bring to scale. But both need to be capital efficient. I think the consumer, there's an awful lot that people perceive as having changed in the venture capital business that is tied to what's happened in the consumer web, but the consumer web is only one part of the venture capital business, even today. It may be the part that gets a lot of the attention from the media. It may be the part that gets blogged about and talked about on the web a lot, but it's one part of it. Yeah. But I do think consumer web is a different model for financing ideas and challenging those ideas in the marketplace with real empirical data before you actually have to go and raise your first dollar. Because they're so, the barriers to entry are so low, there are multiple entrants in almost every category. And the winners are very difficult to pick out before you've actually gone to customer. So it behooves anybody in the consumer web to spend as little money as possible getting their product in front of a customer and demonstrating real traction. That is very different than two scientists who are going to actually have to raise tens of millions of dollars to take things from vat to small process to even show that they can take it to large process at $100 million to create a new material or a new biofuel or something of that ilk.
Exactly.
It's interesting. One of the things, biotech has a long history of big partners, big companies, helping fund a drug to market. You know, it takes 10 years, $100 million, but there's a long history of the big pharmaceutical willing to come in early. You can go public without any revenue and get more cash and hopefully last to the point where you finally get approval of the drug. That doesn't apply in a lot of other areas. I mean, I think KP has tried to get that to apply in green and clean tech, but if that doesn't happen, those $100 million companies are not going to get funded anymore because you need somebody else other than us VCs to help fund that extra risk. And they would only do that if they care a lot. Maybe the power companies will do it. I don't know. Somebody else has to do it. Yeah. Do you agree?
Are we supposed to ask questions? Are we supposed to leave time for questions? Does anybody know?
We only have 2 minutes left.
Because we're running out of
Can I
time.
ask you a question?
You can, yeah.
How many local entrepreneurs are in the audience? Could you just raise your
Local
hands?
meaning Barcelona.
That's fantastic. How many local VCs and angel investors are in the audience? Okay. Are you guys all looking at each other? Okay. Local VCs and angel investors, put your hands back up again. Okay. You've got around you, in this room, some tremendous people. I spoke about one angel investor a moment ago. You've got Nauta Capital. You're in the business of looking for good, smart money. I can tell you that these two groups, Nauta and other groups in the audience here, are just fantastic people. I'm working with Nauta for over a year now, and they are world class. So find your way to the doors of these local people, and ultimately maybe to us. It depends on what you're looking for and what your ultimate objectives are. But be tenacious and beat the door down.
That's great. So I don't know if we're supposed to be allowing time for questions. I don't see any microphones.
I have one parting piece of advice. You know how to tell when a venture capitalist is not interested. There's a Japanese are very polite people, and they never say no. They have an expression called kento shimasu, which translates to, I'll think about it.
Yeah.
And if a venture capitalist, after hearing your pitch, says, I'll think about it, he's being polite. You guys agree? I mean, it just because if we're interested, we're going to tell you, okay, I want you to come back in and talk to my partner. I want to go to this next step. I'll think about it usually means no. It's just a polite way of saying, I'm not interested.
Garrett, you had your hand up?
Well, in terms of sort of parting comments, one catechism that I constantly push on the CEOs that I work with and on myself when I'm acting in the CEO capacity is that the product is the company, not the product. Oftentimes, entrepreneurs confuse the fact that they are so focused on whatever it is that they're delivering that they don't think about the overall game that they're really playing. Mm-hmm. And what you are doing as an entrepreneur is you're creating something out of nothing, and ultimately the objective is to sell that something to somebody, either to a large corporation or to the public. And everything you do, from the very first day that you conceive of the concept through the last day when you have hopefully coordinated things and you are acquired, should be directed towards selling that product, which is the overall enterprise that you've built.
I think that's a great way to end. We just hit 0. Perfect. Hand to our panel.